Here's the uncomfortable truth about interest rates. It's not what you think. And 90% of people get this completely wrong. Most people think central banks just woke up one day and decided to make life expensive. They think high interest rates are punishment. They think someone, somewhere, is pressing a button that says, make mortgages painful. That's not what's happening. Let me show you what's really happening. Sir John Templeton once said, the four most dangerous words in investing are, this time it's different. And yet, every single time interest rates spike, people say the exact same thing. This shouldn't be happening. This isn't normal. The system is broken. But what if this is normal? What if the last 15 years were the abnormal part? Because if you zoom out, if you really zoom out, what we're living through right now is not a random event. It's a sequel. And like every sequel, it started with a decision that felt necessary at the time.
Let's go back to 2008. The global financial system almost collapsed. Banks were failing, housing prices were crashing, fear was everywhere. The world felt fragile. So the hero walked in, the Federal Reserve. They did something dramatic. They cut interest rates to nearly zero. And when that wasn't enough, they started buying bonds, trillions of dollars worth. Their balance sheet exploded from under $900 billion to about $4.5 trillion in just a few years. Money flooded the system, liquidity everywhere. It worked. Markets stabilized. Confidence returned. The economy slowly healed. But here's what nobody tells you about cheap money. Cheap money changes behavior. When borrowing costs almost nothing, people borrow more. Companies take bigger risks. Investors stretch for returns. Housing gets hotter. Stock valuations climb higher. Risk feels invisible. Now, fast forward to 2020. The pandemic hits. The global economy shuts down almost overnight. Governments panic, and honestly, they had to. In the United States alone, more than $5 trillion of stimulus was injected into the economy. Checks went out to households. Businesses got emergency loans. Unemployment benefits expanded. And once again, the Federal Reserve stepped in. Rates went back to zero. The balance sheet didn't just grow this time, it almost doubled from around $4 trillion to nearly $9 trillion in 2 years. Imagine shutting down global production and at the same time injecting trillions of fresh dollars into consumers' bank accounts. That's like pouring gasoline on a supply chain that's already struggling to breathe. At first, it felt amazing. The S&P 500 doubled from the March 2020 lows. Housing prices in the US surged more than 40% in just 2 years. Speculative tech stocks traded at 40, 50, even 100 times earnings. Crypto's total market value crossed $3 trillion at its peak. It felt like a golden age, but it wasn't productivity driving everything. It was liquidity, and liquidity can hide consequences for a while. Then 2022 happened. Inflation didn't creep up. It exploded. In June 2022, U.S. inflation hit 9.1%, the highest level since 1981. Let that sink in. The highest since 1981. Groceries cost more. Rent jumped. Energy prices surged. Used car prices went insane. Wages were rising 5 to 6% annually in some sectors. Too much money, too few goods. Add in the Russia-Ukraine war pushing up energy and food prices globally, and suddenly, inflation wasn't a headline. It was a lived experience. And central banks had a choice. Ignore it and risk losing credibility, or fight it and risk slowing the economy. History had already given them the blueprint. Back in the late 1970s, inflation spiraled out of control. It crossed 14% in 1980. That's when Paul Volcker took charge of the Federal Reserve. He made a brutal decision. He raised interest rates to nearly 20%. Yes, 20%. Mortgage rates touched 18%. The economy fell into a recession. Unemployment rose, but inflation broke. Pain now, stability later. That chapter of history still lives inside every central banker's mind. So in 2022, the Fed moved fast. Interest rates went from near zero to over 5% in roughly 16 months, the fastest hiking cycle in more than 40 years. That speed is important because the financial system had gotten used to cheap money for over a decade. Suddenly, the price of money quintupled. Companies that borrowed at 2 or 3% now had had to refinance at 6, 7, even 8%. Mortgage rates jumped to 7 or 8%. Monthly payments on a $400,000 home increased by hundreds of dollars compared to the 3% mortgage era. Housing affordability fell to multi-decade lows. And here's the twist most people miss. When U.S. Treasury bonds, considered risk-free, start paying around 5%, investors rethink everything. Why chase a risky stock at 40 times earnings if you can earn 5% with almost no risk? Valuations compress. Speculation fades. Reality returns. And that's where we are now. But here's what makes this moment so confusing. The economy didn't collapse. Unemployment in the U.S. has hovered around 4%. GDP growth didn't fall off a cliff. Corporate profits didn't vanish. In fact, markets rallied again. A small group of massive tech companies, the so-called Magnificent Seven, drove an outsized portion of the market's gains in 2023. Some estimates show they contributed roughly 30 to 35% of the S&P 500's total return that year. These companies generate tens of billions in free cash flow annually. They have fortress balance sheets. They can survive high rates. Smaller companies, not as easily. So we have a split world. High interest rates, strong mega-cap stocks, consumers feeling squeezed, credit card rates above 20%, government interest payments approaching $1 trillion per year, and global debt exceeding $300 trillion. High rates hurt, but cutting rates too soon could reignite inflation. Central banks are walking a tightrope. If they keep rates high for too long, something might break. If they cut too early, inflation could come back stronger. It's not a simple story. It's not good versus evil. It's math versus momentum. So what does this mean for you? It means the era of free money was never permanent. 0% interest rates were emergency settings. 2008 was a crisis. 2020 was a crisis. Today is not a crisis of collapse. It's a crisis of adjustment. High rates are not punishment. They are a reset that reminds us that has a cost, a reset that rewards savers again, a reset that forces discipline back into the system. Will rates stay this high forever? No cycle does. Will they drop back to zero next year? Not unless something serious breaks. We are in the messy middle, and the messy middle is uncomfortable because uncertainty doesn't give clean answers. So here's the emotional truth. The goal is not to predict every move of the Federal Reserve. The goal is not to guess the exact month rates will fall. The goal is resilience. Manage your debt like rates might stay elevated. Invest like liquidity won't always save you. Keep cash for opportunity. Avoid extremes, because the loudest voices will scream collapse or new bull market forever. But wealth isn't built by reacting emotionally to every rate hike. It's built by understanding cycles, by respecting risk, by remembering that money is never truly free. Interest rates are high for a reason, and that reason is history trying to rebalance excess. The real question isn't why are rates high? The real question is, are you positioned for a world where money has a cost again? Because in every cycle, the people who win are not the ones who panic. They're the ones who prepare. And this time, it's not different.